Welcome to this deep dive. We're here to take that stack of source material you've got today, it's an earnings call transcript, and really pull out the key insights for you.
Exactly. The goal is to make sense of it all quickly. Today we're looking at Synopsys' Q2 for fiscal 25.
Right. So we'll walk you through the main results, what management said, the outlook, basically give you the need to know without you having to sift through the whole thing. Let's dive in.
Let's do it. This quarter definitely shows a company hitting its stride in some key areas, but also, navigating some tricky spots.
Okay, so let's start with the top line. The big numbers for Q2, what do they report?
All right, so revenue came in at $1.66 billion. That's up 10% compared to last year, and actually beat the midpoint of their own guidance.
Nice beat. And earnings per share?
Non-GAAP EPS was $3.67. That was also above the range they guided for. And the non-GAAP operating margin, pretty strong at 38%. GAAP EPS was $2.24.
Okay, $3.67 non-GAAP. I think I saw a note about a couple of unusual items hitting that number.
That's right. Yeah, good catch. So that $3.67 included a benefit of about $0.28 per share. That wasn't in their original forecast. It came from selling a building.
Ah, okay. A one-off gain.
Exactly. And then on the other side, there was about a $0.06 net charge related to the big $10 billion bond offering they did during the quarter.
Got it. So stripping those out still looks like solid operating performance. What about future visibility? How's the backlog looking?
Backlog's looking healthy, ended Q2 at $8.1 billion. And importantly, that's up $400 million just from the previous quarter. So demand momentum seems to be there.
For a $100 million quarter on quarter, yeah, that's significant. And cash, especially after issuing all that debt.
They finished the quarter with a pretty hefty $14.3 billion in cash and short-term investments. And total debt after that issuance stands at $10.1 billion.
Okay, so summing up the financials, the company's framing this as strong Q2, good execution, resilient model. Seems fair based on those numbers.
Yeah, I think so. The growth, the margin, beating guidance, and that backlog build. It paints a picture of consistent performance right now.
All right, let's dig a bit deeper. How did things look segment by segment? Design automation versus design IP.
Okay, so design automation, that's the bigger piece, brought in $1.12 billion. That was up 6% year over year. Adjusted operating margin there was 40.9%.
Just 6%. Any context on that?
Yeah, they did point out it was resilient, especially because they were comparing against a really strong quarter the previous year. So a tough compare, basically.
And design IP.
Design IP was the faster grower. Revenue hit $482 million, which is up a solid 21% year over year. Adjusted operating margin for IP was 31.2%.
Where 21% in IP, that really jumps out. What's fueling that kind of growth?
They specifically called out strong performance in their interface IP, things like protocols for connecting chips.
Right. And why is that so significant now?
Well, it suggests customers are really leaning on pre-verified IP blocks. Chips are getting so complex. Using proven IP helps them lower risk and just get to market faster. It's becoming critical.
Makes sense. Any regional color? Did they mention specific geographies?
They did. They highlighted continued strength in Europe and also South Korea. And that strength helped balance out some ongoing headwinds they're seeing in China.
Okay, China headwinds. We should probably circle back to that. But first, the overall market environment. How did they describe what they're seeing out there?
They said it's still very much that tale of two markets narrative playing out.
Right. Remind us what that means in their context.
Sure. So one market is AI and high-performance computing, HPC. That remains super robust, just, strong demand, no signs of slowdown there.
Okay, the hot areas are still hot.
Exactly. But then the other market, the sort of traditional non-AI stuff, demand there is still generally subdued.
Still lagging?
Still lagging, yeah. But they did mention seeing some positive signs, stabilization, particularly in industrial and automotive sectors. They even used the phrase new energy and vitality there.
Interesting. So maybe some green shoots in those areas.
Seems like it. And they noted that activity, especially in industrial and auto, is actually helping boost demand, particularly for IP in those segments.
Gotcha. And the big picture drivers, the mega trends, still the same ones.
Yeah, the big ones are AI, obviously, the whole move towards software-defined systems, and just silicon going into everything silicon proliferation.
And these trends are making chip design harder, right?
Absolutely. They directly drive up design complexity, costs go up, and the demands for compute power and increasingly energy efficiency, they just keep soaring.
Which plays right into Synopsys' hand, theoretically.
That's their positioning, exactly. They're the partner helping customers tackle these massive challenges and, crucially, They're also pushing themselves as leaders in using AI itself to improve the design process, making chip design faster, better, using AI tools.
Okay, let's get into some specifics on that, products, technologies.
Yeah.
What were the highlights from the call?
Well, hardware-assisted verification got to mention. There are new systems, the HAPS 200 and ZeBu 200. They said those are off to a strong start.
And those are for emulation and prototyping.
Right. Helping designers test these complex chips much earlier in the flow before they actually make the silicon. Essential for these big, complex designs.
What about advanced packaging? Multi-die, 3D IC? That's a hot area too.
Definitely. They talked about growing adoption there. One key example was helping an HPC AI chip company with a really complex design over 40 chiplets, all integrated together in 3D.
40 chiplets?
Yeah, it's a big technical challenge, and they highlighted it as proof their tools can handle this stuff. They also mentioned displacing manual design flows for high bandwidth memory at a big Asian customer, leading to big productivity gains, showing the tangible value.
In process technology. Are they keeping up with the foundries moving to angstrom scale?
Oh, yeah. They emphasized collaboration with foundry partners for that angstrom-era sub-1 nanometer stuff. They enabled the first 2 nanometer HPC design, apparently, and delivered successful test chips below 2 nanometers. So yes, right at the cutting edge.
Let's switch to their own use of AI and tools. You mentioned DSO.ai, VSO.ai. What's the momentum there?
They reported significant momentum, yeah. DSO.ai, which helps optimize the chip layout, is winning designs for really complex CPU and GPU cores.
Yeah.
VSO.ai, that's for verification using AI, saw a major AI infrastructure customer start deploying it across 5 projects. That's a big commitment.
And for analog design.
Right, ASO.ai. They mentioned a major Japanese automotive tier 1 supplier adopted it after doing an evaluation. So traction across different parts of the design flow.
What about generative AI? Everyone's talking about it. How are they applying it?
They're using it in a couple of ways. One is assistive think, like a co-pilot feature that helps engineers find information or documentation way faster. Hours down to minutes, they said.
Okay, helpful.
And then there's the creative side, actually generating things like RTL code snippets or test benches. Early customers are apparently seeing big speed-ups there, like turning days of work into hours or hours into minutes.
That sounds potentially game-changing.
They see it as foundational, yeah. Necessary for what they call the next big leap, Agentic AI.
Agentic AI. Explain that. It sounds ambitious.
It really is. It's a vision for fundamentally changing how engineering gets done. The idea is let AI agents handle a lot of the detailed implementation work, the repetitive stuff.
So engineers focus on the big picture.
Exactly. Focus on architecture, high-level design decisions, while the AI handles the grunt work. They literally talked about re-engineering engineering.
Wow. How far along are they with that vision?
They use the self-driving car analogy, L1 to L5 autonomy. They said we're currently in the L2, L3 phase, so having specific AI agents for tasks, starting to orchestrate them, it's definitely a long-term play, but a core part of their strategy.
Okay, that agentic AI vision. It makes that 21% growth in design IP make even more sense, right? If you're automating parts of the flow, you probably want reliable building blocks.
Absolutely. That IP growth really reflects the reliance on pre-verified stuff, minimizes risk, speeds things up, especially if you want the latest protocols or to move to a new process node quickly. It fits perfectly with that automation trend.
Any specific types of IP that stood out besides general interface IP?
Yeah, they mentioned high-speed SerDes specifically, huge demand there. Multiple wins for their 224 gig SerDes tech that's for super fast data pipes.
Right, critical for AI and networking.
Totally. And for next-gen interconnects, they flagged being first with PCIe 7.07 wins already. They called themselves the clear leader in UCI chiplet interconnects with over 20 engagements, and supporting NVIDIA's NVLink Fusion for building those massive AI factories.
Okay, quite a bit going on there. Let's quickly switch gears to the ASYS deal. Where does that stand, the acquisition?
Right, the pending Ansys acquisition. So they've got regulatory green lights from everywhere they needed them except for one place, China. Still waiting on SAMR approval there.
SAMR being the Chinese regulator, what's the status?
They said they're working cooperatively and actively negotiating with SAMR. And importantly, management sounded confident. They reiterated they still expect it to close in the first half of this calendar year.
So relatively soon.
That's the timeline they're sticking to. They expressed high confidence based on the deal's merits and the ongoing talks. They even framed it as the only scenario they're considering right now.
Okay, high confidence then, pending that final approval. Let's talk customer dynamics. Did they mention their largest customer? Usually assumed to be Intel, right?
They didn't name names, but yeah, discussing that dynamic. They have multi-year agreements covering software, IP, and hardware. They did say that, if that customer changes roadmaps or strategy, it doesn't usually hit the core EDA software deals much.
Software is sticky.
Very sticky. But there can be quarter-to-quarter variations in how much hardware or IP gets pulled down from those committed deals. Still, they see it as a growth area overall.
Got it. And going back to that non-AI activity, the potential green shoots in auto and industrial.
Yeah, they see a pickup there. Automotive, industrial, robotics. What's interesting is that customers in those spaces are apparently thinking harder now about how much AI capability they need to build into their next-gen chips for those markets.
So AI creeping into everything, basically.
Pretty much. And that thinking could lead to them actually modifying or maybe even increasing their R&D spend on chip design, which would obviously be good news for Synopsys.
Let's talk pricing. How do they approach that, especially for these newer, high-value AI tools or verification systems?
They really emphasized value-based pricing. So it's not just cost plus. It's tied to the actual impact and the total cost of ownership or TCO benefit for the customer.
You give an example?
Sure. They mentioned GPU acceleration in their Proteus product. If it gives, say, a 15x speed up on a critical task, that saves the customer a ton of time and maybe hardware resources. The pricing reflects a share of that significant TCO saving. They see this as a way to capture more value and upside opportunity.
Right. Okay, back to the financials slightly. That RPO and backlog build, you said it implies high single-digit growth visibility. How does that fit with the typical shape of their fiscal year?
Good question. Yeah, that backlog build and the sequential rise in current RPO supports that visibility. They feel it's sustainable. They also reminded everyone about their typical revenue split. Roughly 45% in the first half of the fiscal year, 55% in the second half.
H2 weighted. Why is that?
Part of it, they explained, is driven by when they expect to ship more of their hardware systems, like the new APS and ZeBu units. They have better visibility on those rollouts in the second half.
And any issues getting those hardware systems built? Supply chain constraints?
They said no significant supply chain constraints right now for HES or ZeBu 200, which is good news.
What?
But they did add they'd happily take more supply if they could get it, so demand is clearly very strong. They do expect the supply situation to get even better in Q4, which again supports that H2 weighting.
Okay. Now let's carefully address the China situation. This came up in the Q&A. There's been external chatter. We need to be really precise here, just reporting what was said on the call you reviewed, no speculation.
Absolutely. Very important. Management did address it directly, and they were extremely clear. The company has not received any notice from BIS.
BIS being the U.S. Bureau of Industry and Security, handling export controls. So no notice received. How does their current guidance account for China then?
They reiterated their full-year revenue guidance for the entire company. But critically, they stated this guidance already reflects their understanding of current BIS restrictions and includes their expectation that China revenue will actually decline year over year in fiscal 25 compared to fiscal 24.
Okay, let me make sure I heard that right. They're sticking to their overall company target, even though they assume China revenue will be lower this year than last.
Correct. That's exactly what they said. They pointed out this slowdown in China isn't new news from them. They started flagging it back in FY24. It's due to the cumulative impact of restrictions already in place, plus the macro environment in China. They said the headwinds have actually gotten stronger.
But the overall guidance holds
because of execution and strength elsewhere. Other regions, other parts of the portfolio are strong enough to offset that expected decline in China. That's the message.
How do they handle specific analyst questions about China? Like the mix of business there?
On the mix software versus IP versus hardware in China, they said they don't break it out that way regionally, but the mix is broadly similar to the rest of the world.
What about costs? Can they adjust their cost base in China if revenue is declining?
They pushed back on that a bit, saying it's hard to think about costs region by region like that. Their R&D and field teams are global, integrated operations, they stated clearly. No specific changes to operations anywhere right now based on this.
Did the Q2 China performance come in weaker than they expected? Is that why the full year view assumes a decline?
No, they said Q1 and Q2 China revenue was actually in line with their internal plan. They knew H1 would be tougher. It was down 28% year over year in China, and they expected that. Oh. So they emphasized that reiterating the full company guidance affirms their confidence in hitting the overall number, even with that planned, factored in China decline for the full year.
What if new restrictions do come? Did they address that possibility?
They stuck to the line. Can't speculate on the impact of a notice they haven't received. Fair enough.
And long term. They often talk about a long-term goal of double-digit organic growth. Does the China situation shake their confidence in that?
They addressed that directly, too. Said they remain absolutely confident in hitting industry-leading double-digit organic growth for the company overall, or at least for the core design, automation, and IP segments long-term. They explicitly said they were setting aside speculation about potential future restrictions when stating that confidence.
Okay, that's a lot to digest from the call. Stepping back, what does this all really mean for you, the listener, trying to make sense of Synopsys right now?
Well, I think it paints a picture of a company that's really plugged into the biggest trends shaping tech right now. AI, complex chips, advanced packaging. That's clearly driving strong performance in key areas.
Yeah, you see that in the IP growth, the hardware demand, the focus on AI and their own tools?
Exactly. But they're also dealing with real complexities. There's the macro uncertainty affecting some markets, and obviously the specific headwinds and geopolitical uncertainties surrounding China.
This is a balancing act.
It really is. And understanding those specifics we pulled out, like the Agentic AI vision, the multi-die wins, the high-speed IP leadership, that shows you how they're positioning themselves to keep growing despite the challenges. They're focused on enabling the absolute cutting edge.
And the fact they held their full-year guidance, even with the acknowledged China decline factored in, that signals pretty strong confidence from management, doesn't it?
It certainly does. Confidence in their execution, confidence in demand outside of China, and confidence in just how essential their tools and IP are becoming. Customers seemingly can't build these advanced chips without them.
So hopefully this deep dive gives you that shortcut. You get the key drivers, the strategic direction, the risks they highlighted, all without needing to read the entire transcript yourself. That was the goal here. Break it down into the essential takeaways for you.
And just the usual reminder, this was our analysis of the information in the earnings call transcript you provided us. It's here to inform you about what Synopsys said. It's definitely not financial advice or any kind of recommendation.
Absolutely. Okay, here's a final thought to leave you with, building on that agentic AI discussion. Synopsys is talking about fundamentally re-engineering engineering. If AI agents really do start handling huge chunks of detailed chip design work, letting human engineers focus purely on architecture, that's a massive shift. So the question to ponder is, how fast could that transformation actually happen? And if it happens quickly, what are the knock-on effects? On talent, on innovation speed, maybe even on competition. It feels like a potentially massive disruption brewing just under the surface of these quarterly updates, something to keep an eye on.